Morning, everyone. How are you going? Welcome to Q&A with Whitey. This is our fourth year of running these series, and I very much thank you for support. I think we've got something like 300 odd people around the country registered to join us in our conversation today in regards to LMI. It'll be a lot of fun. LMI is an interesting animal. It's something we need to all be across. But before we get into that, whoops, bang, make sure you've got your morning tea ready, got your cup of coffee. I got a bit savoury this morning. I got some cheese and Twiggies, I think they call these in Queensland. Yeah, something to nibble on whilst we're having a chat to our guest speaker this morning. And of course, want to say thank you to our sponsors that support us all this time. People like AAMC, Affordable Staff, ALI, Amfin, Credit Fix Solutions, Early Pay, Finstro, Heartland, Reverse Mortgages, Insurance Advisor Net for all your PI, Notify, On Deck, OptiPay, Pepper Money, Prosper, Strive Financial, and Trailbook Loans. Yeah, thanks to all those people for supporting us for all this time. We really appreciate it. Now, today, as I said, we're going to talk about LMI, and I'd like to welcome our special guest today, Strachan Taylor, who is Strategic Partnerships Leader of Helia Insurances. We'll talk about Helia later, but Sean, welcome, mate. That's a very young-looking man I see there with a good head of dark hair. Well done. I certainly these days I can see through it already as it's here. So
it's
I need
getting a bit thin.
Yeah, I tell you, it's one of the joys of getting older, I think. Although I must admit, I can go back into the 90s, and I was working in the motor vehicle game doing F&I, and the car salesmen always thought it was a funny joke. They'd be up on the top tier of the dealership. I'd be down here, and they'd be looking through the top of my head going, Whitey, you're going to be bald any minute now. I still got it, but it's just still getting thinner. Anyhow, here's what it is. Strachan, thank you so much for joining us today. I'm really looking forward to this chat about LMI. It's one of those interesting things that are an important part of our marketplace. And it always, I think, is a bit of a challenge from my point of view, to people really understand the full hoops and roundabouts just what LMI does. So we're going to have a bit of a chat about all of that and see if we can't piece some of the questions together. And for everyone who's listening, if you do have any questions, put them into the chat. Our producer will flick them to me via text. I'll get them and we'll deal with them as we go. Well, as long as they're appropriate and relevant. There's a caveat to it. So, Strachan, tell me, how long have you been in the game? I was going to say in LMI, but you might have done other things before. Tell me, give me a bit of your journey as to what you did when you left school and how you got to being where you are today. And we'll cover Helia off a bit later.
No, thank you, Pete. And look, all these things, it is a journey. And I started back in, I was banking in finance way back, actually in foreign exchange, when you had brokers. Way back in I think the mid 80s. I then did some time at a credit union, Broadway Credit Union, as a loan writer, which was interesting and real, coalface stuff, sitting down with people, talking about what they wanted. Then I went and did an MBA, and then moved into slightly bigger operation at Advanced Bank.
I worked with Advanced. When were you there?
There you go. We crossed paths. Mid 90s, I think. Early to mid 90s.
I was out of Parramatta where they had the fast track lending team. So
they had a team out there. I went out there a couple of times to see those guys. I was based in at 182 George Street. There you go.
Okay. There you go. Talking sold to what was it, St George, I think, from memory at the time.
Yeah, then St George came by, and so just after we purchased Bank of South Australia, so I was on that on the sort of deal there, and that was interesting. Then I actually went off and did something completely different. Worked for Lion Nathan, writing strategies on how to sell beer, which was very interesting for about 5 years. And then back into banking and finance with Westpac. I was with Westpac for quite a while. And then when I left Westpac, I actually did some work with Woolworths and Macquarie Bank about could we create a Woolworths home loan, which was fascinating.
Yeah, they did the credit cards on as well at one point.
Yeah, they were doing credit cards, and we got very close. And then Woolworths got a bit of cold feet, and we moved on, which then actually led me to actually try being a mortgage broker for 2 years. And I wasn't very good. But it gave me great insight in just like what you have to do, how tough it is, and the amount of work you've got to put in to be very good in this space. So I learned a lot out of that. And then that got me into the LMI space, which I started with Gemworth at the time, now Helia, back in 2017.
Nice.
So I've been here just 6.5 years or so. And
Yeah.
I look after, I'm the strategic partnership lead. I look after our relationship team, and we engage with lenders, we engage with brokers, aggregators, and industry bodies such as yourself.
So, good stuff. Hey, I got a tip for you. I know it's a bit after the event. From a strategy to sell more beer, make it free.
Yeah, exactly.
Drink bucket loads.
Yeah, good. I hear you.
So yeah, a bit late for that. So okay, so it was 2017 you went?
17 with joined Helia, yeah.
Was it always that name, or was it something else? Has it changed its name?
Look, it has. I mean, if you go right back, and it's an interesting story. Gemworth actually originally was created by the government back in 1965. They had an issue back then, as they probably have now, is how do we get more people into homes? And at the time, it was that banks were very conservative; they couldn't lend over a certain amount, and so they created the home loan insurance company to offer LMI. And then they sold that to GE in the 80s, late 80s, early 90s, I think. And then GE created as a separate business, focused just on LMI, but globally. And we were part of a global operation and that's where Gemworth came from.
Right.
And they had operations in the US, in Canada, in Mexico, in the UK. And then over time, they sold those different businesses off. And then in 2020, I think it was, they sold down their shareholding in us. And we had to change our name. And hence, we are Helia today.
Helia. We are here as Helia. Because if I go back to the early 80s, showing my age a little bit, from memory, there was about 5 LMI providers back in those days.
Oh, so a lot, correct.
Yeah, you had HLIC, Genworth, PMI, I think.
PMI was one. Yep, correct.
I'm sure there's about 5 at some stage, but yeah, there was quite a collective choice somewhere, all jostling for their part of the marketplaces. And
correct.
As time goes by, they all find their place, or otherwise have moved on somehow.
Correct.
Whatever it may be. So let's start, I guess, from the beginning. What does LMI stand for?
Yeah, excellent. Good question. So lenders, mortgage, insurance, and in the name is what it does, right? So what we do is we insure lenders against loss should a mortgage default, and if they sell the property that's security and it doesn't cover the loan, we then cover that loan.
I think it's a really important point, I think, that everybody needs to understand. I mean, whenever we talk about insurance, we tend to think it's protecting someone, an individual. In this case, it's a reverse flip. It protects the lender, as you say, from those cases, from what you point out is from a loss if there's a sale, or in default situations and so on. So it's really important to know, and for everybody to remember, it protects the lender. Key point of LMI is all about. It's in the name, but we all default to acronyms. So sometimes you forget.
And it's a good point. It protects the lender. The other thing it does is actually gives the lender some capital benefit as well, so they can actually hold less capital that they can't lend and lend that out, which is a good thing. The other thing is that by protecting the lender, it gives them confidence to lend at higher LVR levels. And so there is a benefit for the borrower. And it's an interesting insurance too, because normally if you take out insurance, whoever is being covered pays that insurance. In this space, while the lender pays us, they recover those costs from the borrower.
So why is that? So, if we come back to that fundamental piece that we talk about in a very general term, insurance is usually paid by the person taking it out. So it's maybe a car, your home and contents and so on. In this case, it's the lender that is basically taking out. And as you say, the premium that gets paid to yourselves gets passed to the borrower to pay. It's a very unusual set of circumstances.
It is.
And I know this is you're sitting in a biased seat when I ask this. I understand the bias of the response I'm about to get, but do you think that's fair? I've always been challenged by it.
Yeah,
I
no, look,
get it.
it's
I
a
get it.
really
I
good
wonder if
question.
it's fair, but that's
Yep,
what it
yep.
is.
So if you wind back, the contract, I suppose, with the borrower, this is like the lender with the borrower. They go, it's the sort of conversation, if you will, sort of like this, is that once we start lending over 80% loan to value, things get riskier. And if you look at the statistics, it shows that the probability of default goes up and up and up and up as you sort of lend towards 100%. And so the contract is the lender is essentially saying to the borrower, we can lend you above 80, to 90, 95. In fact, there was, go back, we could do it to 100.
Sometimes
but that's
105.
risky.
Remember the day?
Yeah, well, it was. That's right. But as that gets riskier, right? So we can do it, but we need to get insurance.
Yeah.
But if you want us to get insurance, right, so that we can lend to you, we would ask you to pay for that insurance on our behalf. So and that's where that comes from.
The scorpion's tail on that. The banks continually post billions and billions and billions of dollars profit, yet they're making the borrower pay this. Surely there's a rationale in this somewhere, but we all know it's not going to happen because the return to shareholders is going to be more paramount, and they ain't going to go backwards from where they are. But it's an interesting conversation, though. Just to say, here is a very unusual product. We call it insurance. It's a requirement. It's a bit like if you get a loan on a motor car. You need to have insurance, and that protects the person who owns the car pays insurance. So there's sort of some similarities in the world, if I can put it that way. Yeah, but here we have quite a big cost, and we'll come to costs later. But yeah, so the poor borrower gets lumbered with this cost; they're going to pay it, that's the negative side of the coin. The positive side of the coin, you said, it enables them to borrow more, so higher LVRs and higher gearings to minimize that risk. But also too, and the thing that everybody needs to remember with the cost of this, it plays very importantly to the non-bank or securitization sector. Without
absolutely,
they couldn't get the credit ratings and the borrower appetite to be able to create an insurance pool in the manner that would be competitive.
Correct.
A very, very important part within securitization and enabling lenders to get things off balance sheet and out of warehouses or wherever they've got it going, and to be very competitive in the marketplace with their pricing and what they do. So,
creates a bit of liquidity too in the market, which is good, and gets those whole markets going. The other thing it does, and this is probably the more important thing, is, and I absolutely get you on the cost, and it is a cost. I'm not shying away from that. It can shorten the time frame that people have to sit outside of the market. So if you only need to save 5% of the value of the property plus costs, as opposed to 20% of the value of the property plus costs, it shortens that time significantly. In Sydney, it can take you somewhere between 12 and 15 years if you want to save the full 20%.
Is that right? It's huge. It's an interesting stat. Doesn't surprise me. And this is a slight track, but to me, always a misnomer of FERFI. And I know it's big in New Zealand, and we're just branching into New Zealand at the moment. I'll be having conversations with the regulators over there separately. But the whole call for using your superannuation or your savings for your deposit. Now, the amount of super you pay every year compared to the level of money you need to get that 20% deposit and your costs, going to take you a long time. You're never going to get there. In my mind, just in simple maths. I mean, some people will, some people won't, but there is a lot of money you've got to save to get to stay. Was it 15 years plus to be able to get somewhere?
That's right. And so, if we can halve that or reduce that significantly, it gets you in the market earlier, and over time, generally, the property will increase in value. Not always, and it's over a long time. So, you've got to be cognizant that properties may not go up in value, at least for a period of time. So you've got to be mindful of that. But if it can get you in earlier, then you've got longer to actually earn some capital gain in terms of that property.
Yeah, we've got some interesting questions coming through. I'll ask at the appropriate time, but they're very smart questions. I love smart questions, and they're good.
That's good.
Okay. Well, that sort of, I guess gets the head around as to what's happening with who pays for it and so on. I guess in that conversation, then what does LMI cost on average? Because is it a percentage of the loan amount? Is it a set figure? Does it vary? Does it vary between lenders? You know, so like, a top tier bank might be priced at one rate. Is a second tier bank priced differently? Is that sort of thing like a risk balancing thing, or
it does, and it was bigger differences in the past, but the market has, you know, and you'd be well aware of this. The market has radically improved how it underwrites, you know, loans, and so the quality of risk assessment now is significantly more. Therefore, those variances are not there. The variances were there in the past because of the difference in underwriting capability. And look,
so that's rationalised out a fair bit now. Or is it still?
Yeah, it's still there, but it's not like there used to be quite large differences. It's that they're very minor now. If you go across the market, the
competitiveness between lenders, so that's good.
Oh, totally, 100%. Look, and the way it is priced, it's generally a percentage of the loan, and obviously if you're borrowing 81%, then the price is a lot lower as opposed to 95%. It generally costs, depending on your LVR and the loan amount and all that sort of stuff, between 1% and 2% of the value of the loan.
Okay, so 1% and 2%. So on the average loan sizes these days, you know, you're talking somewhere between 8 to 10 grand, just as a rough number. It could be
that's pretty much in the ballpark. And yeah, as your loan goes up and the LVR goes up, that can get higher.
Yeah.
You know, the other way I like to put it, and this is an interesting way of looking at it. So in Sydney, you know, average property, you know, to buy a home, you're probably going to be borrowing close to $1 million, right, to buy a house in Sydney. And the premium on $1 million loan is around $40,000 to $45,000, right? And you go, wow, right? That is a big amount of money. And I go, okay, it is. Don't get me wrong, it is.
They're big loan sizes, so don't get me wrong. But it's a big number.
It's a big number, right? But the property values in Sydney, on average, over the last 30 years, and you can check this with CoreLogic, have gone up by 6% a year in the long term, right? Yeah. So if I've got $1 million plus, let's say I've borrowed 90% and my property's worth just over $1 million, if that's gone up by 6%, right, in a year, you're getting around $60,000 to $70,000 capital appreciation, but it's cost you $40,000 in premium to get into that property. Yeah. Right. So big numbers, but they do have a return. Okay. And that's sort of one of the ways to look at, is this worthwhile? Right.
Okay. So here's another one for you based off that. If I was borrowing purely for investment purposes, and I had a 40 Rand bill for LMI, is that tax deductible?
Yes, it is, because it's a cost. It is a cost of borrowing, like all your costs. It's an investment, right? And the government are all sort of kicking around. What are we going to do with negative gearing, all that stuff? We'll let that run its course. But today, right, it's an investment, and all costs put into that are then netted off against your income. And so if your costs are greater than your income, then you can actually claim those out, right?
Okay, well, excellent. So it's tax deductible. That's an important piece to understand. If we're talking investment, I imagine that plays across to business lending if it applies. So if people are getting a pure business loan geared against a family home, and there's LMI, I imagine the same tax rules. Speak to your accountant.
Yes, I'd say don't take mine. Speak to your accountant. Definitely.
From our point of view, I think that sort of ticks a box somewhere, and very worthy to remember and to ask a question of the professionals in that sector. So that all of a sudden starts to make things a little more reasonable if you're in that sort of a dollar market. It's probably, you look at it, so it's pretty tough on mum and dads, but it has a bit more of a sweetener from the investment and business point of view. But it's a reality of where housing property prices have gone. So if I go back and I swing back to those early 80s era when I helped with people like Rams and others at Marketplace or Advanced Bank and stuff like that. The property prices were a lot less, so the loans were a lot less, even though the percentage for premium hasn't changed a lot. Like it was never like it was 10% or anything like that.
No,
it was single digits somewhere.
Yeah, so the LMI price, and this has become an issue, and hence the government looking at schemes to help in that space. This has become an issue over time because As loans get bigger, you're just getting a similar percentage on a much bigger number, so your costs are going up.
Yeah, yeah. Okay. So I guess one of the things that then comes off the back of that, because I know it's not always, but it can be a very sizable cost. And for some people, 8 grand is a sizable cost too. Is it possible that if I do a simultaneous settlement, I sell my own occupied house and I move into a new occupied house, is LMI portable? Can it swap between security assets like that, or is that not the case, or is it problematic, or what? How does that?
It is, yeah. Okay, so look, it is to a degree, and it is the problems come when you're shifting lenders. So if I if I had my loan with lender A and I stayed with lender A and I sold that property, bought a new property, updated my loan, but I had LMI originally and I'm still going to it, we do a thing what's called top up. So what we do is we say, let's say you've already paid $10,000 on that premium or that property. You're now borrowing a bit more, you're changing security. We credit you the original 10 already paid. And if let's say the new premium's 12, we say you just need to pay an extra 2, right? So that's the first one.
Cool, because that never used to be. I used to have a big bitch about this in the media, and there's a whole lot of LMI providers that had my face on a dartboard over some of this. So I'm really glad to hear someone stepped up and dealt with that piece. It says even, at the moment with the same lender, or they're paying a pop-up tweak, which is commercially reasonable, right? Yeah. It's not like that's an unreasonable position. It actually was where my commentary was back in the day around that you should have to pay that. But that's with the same lender. What happens if it's a different lender?
Yeah, so unfortunately with a different lender, with the premiums you pay up front, then you don't get that credit because it's 2 different groups you're actually insuring, because you got to remember we're insuring the lenders, not the individual.
Yep.
Now, to try and solve for that, we have looked at it, the industry has looked at it for quite some time. Yep. Look, there's no portable insurance in any sector, right? So if it's car insurance, you stop paying, and with one, you pay with the other. But generally car insurance, you will get, again, you get a credit what you haven't used. Yeah. And look, we do, and sorry, I'll way back. If you pay your loan out within 2 years, then we will credit you back some of that premium, right? Okay. So if you only have that loan for 12 months.
How long does LMI actually give cover for then, isn't it? So like against a 30-year loan, does LMI cover you for 30 years, or does that cover the lender for 30 years?
No, it covers the lender for the full 30 years.
Why is it only 2 years?
Yeah. Again, statistics.
It's a question.
No, it's a good question. It's a very good question. It's statistics, right? So if we're going to get a claim in the LMI space, most of our claims occur in the first 5 years. Yeah. And look, it's a bit of an industry standard. It hasn't changed for a very long time. But because of that, we are willing to, because a lot of that premium gets utilised in the first few years of the contract. And so in the first year, and this is industry standard, right? You'll get 40% of the premium back, and if it's in the second year, you get 20% of the premium back. Now we've been looking at, can we extend that? If you do extend it, it increases prices. It's a big trade-off that we work with lenders, and so far all lenders have stayed at the 2 year. Just makes it simple. That's all.
The quandary becomes then you're protecting the insurer for technically 30 years.
Correct.
Right. So in year 28, if something went horribly wrong, the lender could claim on the policy.
Correct.
Right? But from a refund point of view, if I can put it that way, when things, or this point of view, you're saying on average it's first handful of years or first couple of years where the business risks are. So why, if you made it past the first 6 years and there was no claim and the premium continues to protect the lender, why isn't there still a if in 15 years I pay out my loan, why don't I get something back?
Because it's a hard one to get. They do what's called an earnings curve, and they apply the premium over a period of time. If you go back and you're looking at quite long stream statistics in terms of how the payouts go, I have to say it's just they've gone to an industry they'll pay back at the first 2 years. After that, they just don't. It's been in the industry a very long time. Could it be challenged? Look, it could. every time it is, we look at it as, we look at it as an industry. What it will do is it hike premiums, and we just didn't want to do that. They're high enough as they are, and so the industry has agreed just to keep it at the 2 years.
So I guess that's the great debate, and maybe I'll keep talking to government about it. Maybe I won't. Well, we'll see. But because the great debate is, you say, you'll push premiums up, but the premium already covers 30 years. Right. So
yeah, but the pay again, like insurance.
I sit there, sort of, why would it push premiums up? Because it's already covering 30 years. And don't get me wrong, the reason for this is a broker needs to be able to explain this to their borrower.
Yep. So, like all insurance, the premium you pay is only a fraction of the cost of the risk, and because you're paying, and we get a big collection of payments. Therefore, they can help cover when something does go wrong, right? So, and that's what keeps the premiums, at a manageable level without getting too high. If we were to refund all those premiums at any juncture in a 15 or 30-year period to cover those claims, you'd have to lift, because you're getting more payouts. You have to lift the base.
Well, the risk is, but
correct.
Your data's showing it's in the early part anyhow, so the risk is still minimal in that exposure frame. But and then playing off that, God, where was I going? Who pays if you say the premium is a fraction of the cost, who pays the rest of it?
Well, what you do is it's a pool, right? So in essence, everyone's contributing to a pool.
Yep.
Right. And out of that pool, when there's claims, you pay that. So, and that's with all insurance, like car insurance, house insurance. You all contribute to a massive pool, and therefore that's why your house insurance is only a few $1,000s and not many thousands of dollars. Because if something does go wrong and someone puts in $1 million claim, right? Well, no one's writing $1 million premiums, but all 1,000 people have contributed 1,000. Their funds cover that claim, right?
So everybody's
the way insurance.
You tell me this is the way insurance works everywhere on everything?
It is.
Oh my goodness. That's, all right. We've got some questions that keep coming through. So I'm going to tackle a couple of questions. We've already tackled one, and then we'll talk about a few other things, and we'll come back and we'll do some more questions that are being asked.
No worries at all.
So that's all right with you. So one of the questions here, so I'm just making sure I get it right in my head. It says, does the interest rate differential not already cover the increased risk? Is it not a form of double dipping to load the rate and charge LMI? Now, I guess this is talking about in the construct, and you may not know this, but from a lender perspective, if it is built into the construct of an interest rate marginalisation, so the difference between cost of funds and retail funds, if it's already built in there and then they charge a premium again, this question is, are they not double dipping?
Now, not really. I mean, if it wasn't being insured, they'd charge a significantly higher interest rate to cover that. The insurance helps keep those rates at a manageable level, I suppose, at a competitive level. So you've got to look at it as a blend, right? And so if the insurance is 1% and you're paying 5.5%, and it's essentially 6.5%, would the lender charge you 6.5% if they had no insurance? Probably not. They'd probably charge you more. So it's and with funding, the Treasury's raise funds from all sorts of different sources. They've got to pull it all in, blend it, and try and get a price out of it.
So is it fair to say, and I'll phrase it this way from your understanding, and not Helia, but from your understanding, that there is no marginalisation of LMI into the construct of a rate? Would that be right? Or they
it's look, at the end of the day, we don't get involved with the way lenders price their books and price their loans. It's not really, right? I'd say.
Okay. All right. We won't go any further, so I get it. I have the same argument when it comes to clawbacks. From my point of view, the provisioning of a clawback is already built into the marginalisation of a loan. This is why the branches don't get clipped on their P&L when a loan terminates early. And my view is that lenders do double dip on clawbacks. They get it in the contract rate, and they then ping the broker for it. That is my bitch on that sort of piece, because I know that's what happens. Trying to get the bastards to actually acknowledge it. I'm working with government on that. We'll get there. But anyhow, it's all in conversation. Here we go. Is there, I should say, a geographical difference in LMI? So depending on where you live, does it vary the LMI, or is it really a risk profile on the lender? Which could be
more. So if you go for a borrower, it's risk profile, right? So Equifax and all that sort of stuff does that. In terms of regional, we don't. It's not price. It's more LVR, right? So there are some areas. There are some areas which are either what we call high density. In other words, there's a lot of concentration of properties. And so they're a little higher risk, but we don't change the premium. We just say you can only borrow to, let's say, 90%, 95, right? So it's managed that way.
Yeah, so that's geographical, and that also then plays back whereas in different states or regional areas and so on as well.
Yeah.
So the next question is, I think we might have dealt with this one. They're coming through thick and fast. Thanks, everyone.
That's good.
Is there a double hit through the lender when they increase interest rates? Oh, this talks back to what you're saying. So
not really.
What you say is that they push up interest rates, and they also put in a little extra squeeze for LMI. I mean, it's a difficult one because, as you said before, Treasury pulls their marginalizations from a whole host of different areas.
Oh, heaps, yeah.
But my gut says I bet they do, right? Proving it's a whole nother thing. So I'm not asking you to answer that.
Exactly.
My gut says I bet you.
It's hard to answer when we don't price that for them. But
Yeah. Okay. The process of getting an LMI or getting a premium refund needs to be radically improved. At present, it's almost impossible to get a refund. Now, you did touch on this before. What's that process look like? Because I can remember, and I'm going back maybe 10 years, I examined the processes in a paper I was putting together, and some processes were easy. Some processes you're going, nah, that's never going to happen. And part of it, from memory, was there was a time frame piece. What's the process today? It's probably the simplest.
Well, look, it varies by lender. Okay, so they've all got their own processes in handling loan origination and
sounds like a loan application.
Loan origination and also loan termination, right? So, what I will say is, though, if you are terminating and you believe you're eligible for a refund, you state that up front to your lender and you push it with them. And look, if the loan has been paid out within the 2-year period, but let's say it's 3 or 4 years down the track, you sort of, we should have got that refund. We still have the funds. We will still refund it. We just have to be advised by the lender. And so you just need to talk to
Sorry, I was going to come to that. That's the big point. It has to be advised by the lender. So the borrower has to push the lender and somehow, hopefully, and this is where probably brokers can help as well, is the lender needs to advise the insurer.
Yeah, because we're insuring the lender, right? So they come back, and we get reporting from them on a monthly basis on loans originated, loans paid out, and we can run programs to say, well, this bunch of loans should be getting a refund, and we'll do that, but they have to advise us.
Okay. Interesting point. So you always sit back and wonder, and I know from even the operations that we do here at the FBAA, you always look at ways to improve processes and systems and so on. And I understand the principle of it, in as far as the lender's got to seek the refund, but I always thought that was a tough call because you're relying on a third party to actually do something. And to me, I think that's where the crack is, right? When the problem, somebody hasn't passed a message on. Oh yeah, I've done that. Find out nothing's happened. So there is a window to do this in. Is that correct?
Oh, if you've paid it out within that 2-year period and you're eligible for a refund, we've done some remittance. That's some of these are 5 and 6 years since they've been paid out, but they were due it and we weren't told. We will pay it out, right? So it's if you were due a refund, there's technically no time that'll fade. We've just got to be told, and then we'll go.
I remember some reading, and it wasn't you guys, but LMI procedures back in that period, where it was, I think, only 30 days or something like that, and it was just like it's just not going to happen.
But we put time frames on it, so it's not open ended. So there's a process. However, and I can say this to you guys, if it's gone beyond that, you realise you should have got one and didn't follow it up, or you've asked for it and it hasn't been followed up, push the lender, and even if it's been 1 or 2 years down the track, if it was genuinely open there. I mean, you should have got a refund. We'll make sure that happens.
There's a third one in that, and that is you don't know what to ask for if you don't know. So
Yeah,
again,
true. Absolutely.
to the brokers and the lenders to make
Yep.
sure that consumers, when they're borrowing, are aware of these things. And I don't know if it exists in the market. It's been a while since I've written a loan, but it's almost like you need a little fact sheet, a little cheat sheet to speak to your lenders through when you're talking about LMI. Make sure you cover all the points. So,
yep. Now we've got fact sheets as well that we can provide, and after this, I'll make sure you've got links to our website. We can get some fact sheets for you too,
and we'll get them up on our website. And we do communication with CPD points at the end. So, Kelly, who I know is listening in, our producer here.
Yep.
Get her to make sure it goes in those communications so people get those things. All right. Excellent. All right. So I have another question here about, most lenders would have equity in their, home, say 10 to 15 years. Why charge insurance premium for the full term of the loan? I think we've covered that. Whether we agree with it or not, we've covered that, I think. What is the claim versus premium paid calculations given the property prices have surged recently? I guess that's a claims ratio sort of question.
Look, it's interesting.
Because property prices have gone up, the chance of risk of the lender losing in a forced sale situation has probably gone down. But at the same token, and that's another question, and it's not really you, it's a lender question saying, do lenders just sell it for whatever they can get, or do they generally try and optimize the price to minimize any losses from an insurer's point of view? Is the claims rate, those claims ratios moved around through the
they have. No, they have. They vary a lot. I'll go back to the worst period we had in recent memory was the mining collapse. And if you go back to
my lights went out.
You're good. Okay. We had some big claims there because there was a bit of a distortion in the market where properties in the mining towns went, quadrupled in price really quickly and then almost went the other way. So there was quite big payouts there. We're in a period now where prices have been quite strong. And the other point you make though is, lenders used to, sell up and move on. The Royal Banking Commission's probably completely changed the way that lenders engage with borrowers about getting the best outcome for them. So historically, lenders usually just sold up quickly because it was viewed as just a cost and we'll get out. If it was insured, we'll claim and on we go, right? Now there's a lot more work around how can we help you get the best outcome. And so that might be where you are, you've lost your job, you're sick or whatever it is, you're not going to be able to get back to repaying this loan quickly. Property is in a good state. We advise you should sell, and we'll help you do that to try and minimise the loss and optimise it. Or it might be, look, we can put you on a hardship for so long, we can help you get back on your feet, and then longer time if the property price goes up. Look, when people say property prices are going, they do, but they also do come down. We look nationally. There are plenty of suburbs that are still underwater from 3 years ago. So it's to say that they're always going up over the long term. Generally, yes.
Generalised.
Correct. Yeah, exactly.
And then people ask me about property prices, and you say, well, you can only generalise stuff because I know.
Correct.
Not so much where I live now, but one side where I used to live was on Brisbane River. The other side, there are different premiums, different LVRs. Some people had flood risk appetite. Some people did. Twice in bloody Brisbane River, but anyhow, So the dynamics are constantly playing. It can vary from one to another. So, as are the complications within the insurance regime in general, not necessarily LMI, but the insurance game is a complicated and tricky little piece.
It is.
I've got somebody here saying sounds like government needs to recreate competitive market again, just because the coverage period, 30 years for the lender, 2 years as a rebate to the borrower. I must admit, I'm still a fan that says, well, wait on, there should be proportionate rebate longer. But what we don't want to see is premium cost goes up. And as you mentioned before, this is only a portion of cost that's...
it is. It's a very small proportion of the actual potential loss, correct.
So, it's an interesting thing. I don't think if we had like an HLIC, which was the government insurer way back in the day, they'd probably do the same as everybody else. They're risk averse too. because they're playing
Yeah,
with.
look, they did, but it did get many, over the years, it's got many millions of people into houses who might have got there eventually, but got them in earlier, which is the key thing for it. Yeah.
Yeah. It's this is why there's such an interesting conversation. There's so many moving parts on this, and we've all got to get around it. And don't take this the wrong way, and this isn't a pushback on insurers, but yeah, there's a whole lot of stuff we probably won't agree on, but we need to understand it because it is what it is. It is how it happens today, and your borrowers need to understand this. Yeah.
And that's a really good
the
point.
rest of the argument will continue somewhere else.
No, but we take that view too, right? So first of all, LMI is not for everyone. And we do encourage, borrowers and brokers especially, and I know all brokers, they do this. Look at all your options. Yeah. And do you qualify for a government scheme? Yes or no? Can your mum and dad help you out? Yes or no? Are there other options? Could LMI help you? Yes or no? Let's have a look at all the options. And that's all we ask. We just want people to put all the options on the table and then work with your borrowers to go, what's going to get you into property quicker?
Yeah. So question from that, do you know what the average LVR is in the marketplace for home loans? Was that LMI?
Yeah, those stats. Those stats are there. Look, off the top of my head, look, if you look at a lender's book, the average LVR of the entire book's probably around 60 to 65. If you have a look at their actually originations, it's probably around, I would say it is probably sub 80, because over 80 is probably only 4 to 5% of the market at the moment. Because the market is largely a refi market. When it is going really well, it's probably more like 15 to 20% of the market might be above 80.
So it's an interesting, it plays back to, we're having this big conversation. Are we talking about a big conversation for 1% of the marketplace?
Correct. Yeah. And look, at the moment it's fairly small because most of the market's refining as opposed to buying. As the RBA settles on their sort of rate standing, which they seem to be, then confidence comes back. People get a bit more comfortable about, well, I'm not going to sort of borrow and then see my rates go up 10 times in 10 months type thing.
Yeah. So in the mix of all this then, can borrowers pay LMI by the month?
Yes, they can. We've had that in market for about 18 months now, maybe a bit longer. It is only with 4 lenders. They are smaller lenders. The reason for that is paying monthly. Well, and look, it's great. It's been in the States for about 30 years. We brought it in about 18 months ago, but it is more complex to set up in bank systems. Now, if anyone's ever worked in a bank,
profit. I just heard $5 billion for half a year.
Yeah, pretty much, right?
Spend $100,000 somewhere.
So look, it is, as I said, 4 lenders currently, small lenders, but we have some larger size ones lining up there, and most brokers would know this. All lenders are going through some form of replatforming, systems upgrades. So we're just waiting for them to catch up. But yes, you can pay monthly with a few lenders, and we hopefully in the next sort of 12 to 18 months have a lot more on our panel. Yeah.
Okay. So those watching this, you probably need to check through your aggregators to find out who those lenders are, because it's a part of, I guess, the obligation under a best interest duty as well to ensure that you're putting their interests ahead of anything else and understand
100%.
data and how they work and interrelate with each other. Because an interesting question that came up here, of course, is that, what about the poor borrowers that have taken out, let's call it the 40 grand LMI, and it's in the construct of the loan, they pay out that loan, and yet they've got to go back to square one again and pay it all again, potentially, maybe even more. But they've all that, in the loan. So their loan amount is inflated by whatever the LMI cost is. Their loan amount is inflated day one if they build it into the borrowing. They pay that out and take another loan, which includes the original cost of that premium, and now they add more on it, and of course they're paying interest on it as well. It's a difficult one to, I guess, to nail down, except that's right.
Well, it is if they borrow again with the same lender and they've paid LMI and they need to pay it again, they're going to get a credit, right? So that's one thing. If they're changing lenders, then they're going to be doing an economic view, right? So is it better off for me? Look, the costs are costs. Is it better off for me to go with this lender and buy my new house through them, or is it not? So you got to sit down. And brokers are very good at this. They run the economics. What's best for what's best for you? Who should you go with? All that sort of stuff.
Yeah, exactly. I mean, I got a question here around, house insurance is only charged annually, so why is LMI a lump sum up front? But I guess that's the risk pool that everything's contributing into, and the dynamics.
Yeah, and look, that was just the way they structured it, because you don't take, house insurance is only offered annually. They used to only offer it in one lump sum. You can now pay that monthly. LMI, because you were insuring for such a long time, they said pay it all up once and then it's done.
Yeah.
Move on.
And now there are some options, regardless of how much
there are.
pay monthly as well. So that's a really great innovative piece that in my mind is new, because back in the day there was no pay monthly. It was too tricky.
No.
The portability wasn't there. So these are positive enhancements, I guess, to the product and features of what LMI now does, compared to it never used to. So the portability and pay monthly, they're both fairly new options. Would that be right? Like in the last couple of years?
Monthly certainly is. The premium credits has been around a bit longer when you're financing internally. But yeah, look, if the market was all on monthly, then portability is not really an issue, because you stop paying monthly with one lender and you start paying monthly with another one. So, and that's where we'd like to get the industry, but it just takes time to change.
Yeah, I guess. And this is my 45th year of being in this industry, so I'm only just seeing a change in LMI. So in the last couple let's hope things change quicker as we go forward. There's good reasons too, and it's innovation. As you made comments that some things have been going on in the US for a bit longer. I think there's always lessons learned to look outside of the country and understand what other people are doing and how they're dealing with those particular things in those countries, and saying, is it feasible, financially, economic, whatever the thing is, to actually do that here in Australia, and does it make sense to do it? So long as we're always questioning self, pushing the boundaries, looking for that innovative approach to stuff. I know it probably seems in some respect it takes a hell of a long time to get somewhere, but it will get there. And I think, as we've seen in other things, like phone technology, right? My first mobile phone was this bloody great brick that on a big battery, like a car battery. And innovation, will continue to speed up as it continues to get its momentum. So it's interesting stuff. Whilst we're still on the paying monthly, I've just had a question come through. When paying monthly, over what time frame are they allowed to be paying?
Yeah, no, that's a really good question. So generally lenders will agree. So insurance, there's industry way we look at it is, we say there's an attachment point for the insurance. So that's when you write the policy initially, and then we say there's an detachment point when it falls away. So generally, the lender will say it won't be purely 80%. And the reason for that is because property values vary, right? So if they come off risk today at 80% and the market goes down and they've still got the loan, but it's actually 82%, then they've got capital issues, a whole bunch of stuff. So generally, they'll say the detachment point is at either 78 or 75%, roughly, LVR. Now, the borrower, if they think there's been significant house price appreciation on that loan, they can ask the lender to review it, right? And if they're comfortable that the LVR is low enough, they can say that we no longer require that insurance, and that just drops away. The other thing is that the actual premium you pay is set at a fixed amount. So we assess the loan. We say, okay, let's say it's an 85% lend. We say the premium for that is, I'm just making these numbers up. It's $150 a month, right? And so that's it. It's $150 a month every month for as long as that policy is there.
Right. So that could go on for 30 years.
No, it won't. Generally, let's say at 90%, it usually takes 4 to 5 years to drop below 80 on standard house price appreciation. That can fluctuate, but it will always drop off. It will not go beyond a certain time frame. We also have calculators for brokers and the lenders to say what's best for you. Should it be an upfront, or does monthly work for you, for those that offer the monthly? And there's some scenario tools that will show you, if you think you're going to be over 80 for longer than 5 years, then maybe it's an upfront premium as opposed to a monthly.
Who monitors that? The insurer? So like there needs to be a proactive measure that obviously the
lender does that. They'll do that. Yeah, they do that. Yeah.
Are we sure?
No, well, they meant to. That's part of the contract. Yeah.
It's on the lender, right? Yeah.
Yeah.
No worries. Gee, the question is still coming through.
That's good.
What percentage of LMI refunds paid out in full within 12 months? There's a bit of this I don't quite understand, but
yeah, how much of our premium do we pay back? It's not a lot. People generally, as you know, if you're taking a home loan, you're generally not going to do much with it in the first 4 to 5 years, to be quite frank. So it's very small. I don't know the exact figure off the top of my head, but it's very small.
Yeah. Okay. Right. Yeah. Next question here is, back in the day, what was the house prices? LMI is radically more expensive. Prices 7 times the income compared to 3 to 4 times back in the day. So I guess to try and paraphrase that a little bit, the percentage weighting of the premium against a loan today versus that sort of equivalent 20, 30 years ago, is it, and I think we spoke about this, is it still roughly?
No, we did. It's roughly, look, it has largely ranged from 1 to 2%. It does go a little high, I think 1 to 2 and 2.2%. And that's on the value. And you've got to understand that, go back 30 years and, house, you could probably buy
it's not too many of us can do that, but you and I can.
No, but anyway, you could buy, look, let's say average house prices back then were a few $100,000 as opposed to near millions. Then your premiums are a lot less, and therefore if there was a loss, it was a lot less. Nowadays, if there's a loss, it generally is, it can be a significant loss. Hence, that's, like the tide coming in, everything's just lifted up.
Yeah. Unfortunately, it's happening everywhere. Look at inflation. All right. Well, we're getting to a close as to our time frame. That's gone quickly. But so I'm just checking my messages here. I think that's probably close to the incoming message. No, there's one more coming. We'll see what
that's all good.
I've gone through my list as well, and I'm going to ask you for any closing comments, which I will do. Any tips and tricks that you see as where things seem to be a bit of a failure from an insurer's point of view, saying, guys, you get this wrong all the time, or something like that. Let me just see what this is coming through. It's still doing its thing. Excuse me. I don't think I missed anything along the way. No, here we go. After insurers paid the lender, does the lender still go? I was going to ask this one. I forgot. Thank you very much.
Yep.
So this is an important piece. From my understanding, when I was broking or lending, it may have changed today. It used to be, if the lender sold a house, let's call it a repossession, what was in possession, they made a loss, they claimed on the insurance, the insurer paid. The insurer then would go the borrower to get their money back. Is that still the case?
It can happen. Again, it has, let's say, it's evolved a lot. So look, technically, yes, right? But we work closely with the end borrower. We assess the situation. We make, we basically work out, is it worth our while, right?
It's where I was used to land. So look, if somebody's got a mortgage in possession, they've probably got nothing left in here. There's nothing to charge.
Correct. No. So look, it is certainly part of the standard insurance, right? Standard insurance that we do. We do a lot of work now assessing whether that's even worthwhile. We basically outsource that whole assessment and process now to different groups who actually are much better at this. But yeah, look, technically, yes, we can get that money back, but it doesn't happen that often.
Okay, all right, yeah, because that was always the bitter pill in my mind. We wind it right back to what this is. It's an insurance piece that covers the lender. The borrower pays for it. If something goes south, they're still going to get hunted after the premium's been claimed, the insurance policy's been claimed to get it paid on. It seems like a never-ending dark hole that the poor borrower's been spoiled.
Yeah, no, it's evolved a lot since then.
Good, I'm glad to hear it, because that was always a topic. And I know we've touched on this, but the other question came through: is LMI easily transferable from property to property? I assume the answer to that is yes. If it's the same lender, it's more complicated.
Correct.
If it's not,
if it's the same lender, but if you're refinancing to someone else, then it's not.
All right. Great. We've got to the end of the questions. We're just a few minutes ahead of time. Any tips, tricks, words of wisdom, Strawn, that you'd like to leave our friends with that have joined us today?
Yeah, sure. Look, first of all, thank you very much for having me along. Look, when you're assessing options to get into a home or an investment property as soon as possible, we just say to have LMI as an option. There's a bunch of stuff out there that can assist you, be it government, be it federal, state, all these different things. Definitely look at those. Look at what your parents can do, friends and relatives. The other thing I will say is we do have a product which you can get a 15% discount off the premium if you've got like parents or relatives that are willing to pay the LMI up front. All right. So we offer that straight off. So there's another little value there, but we say, look, cast your net wide, have a talk to your borrowers about all the different options, and please just have LMI as an option to consider.
Yeah. Beautiful. Thank you very much. Strachan Taylor, Strategic Partnership Leader at Helia Insurance Australia. I got it all. Mate, thanks so much for joining us today. It's a really interesting conversation, a very important one that brokers all across Australia need to be across and be in front of, and to make sure that their borrowers are fully aware of what this little piece in the puzzle is all about. Mate, thanks so much. Look forward to talking to you again. Appreciate it. Thank you,
Whitey. All the very best. Bye-bye.
Thanks, Strawn. All righty. Thanks, everyone, for joining us. It was great talking with Strawn. Hopefully, you got some good intel out of that and a deeper understanding to make sure you keep your borrowers informed as to what this damn thing, LMI, is all about. It's going to cost them money. Anyhow, thank you for joining us. And, of course, we're back again on the 20th of March with a special guest, Nomica Georgiadis. Be an interesting conversation. I'm not going to tell you any more about that. You'll need to join us to watch and find out. But, of course, like then in the 20th of March as now, we thank our sponsors for all the work they've done with us and keeping things in a manner of which we can. That's free for you to attend. And we thank everybody there on screen. And of course, you're going to get an email shortly. It'll have your CPD code on it and also details. Hopefully, Kelly will be able to do that for me from Strawn in regards to links to Helia's website, so you can get some more information from there and make sure